Now the topic before us is spot market and forward market distinctions in foreign exchange trading. Foreign exchange market operates as spot market and forward market. Suppose I want to visit a foreign country. Suppose I want to visit Russia, where currency is rubles. I am living in India. So to visit there, when I reach Russia, I will have to check in some hotel. I will be taking food, paying for the same. So for accommodation, for food purpose or any other buying and selling of and buying of any other goods, I will require the foreign currency. Because I am from India, I will require the foreign currency, that is rubles, which is the domestic currency of Russia. Suppose I am to visit, say, after 2 days. So I will purchase after 2 days. I will be purchasing the same immediately. Immediate purchase of foreign exchange. So spot market is the market where the foreign exchange or foreign currency is purchased and the buying and the delivery of the foreign currency usually takes place immediately, that is within 2 days, T plus 2. That is, in case of spot market, there is the importance of time of delivery. That is when the delivery of the foreign currency will be made. But if we say want that the delivery of foreign currency is not required immediately, we want foreign currency at some future date, though the exchange rate will be determined at present. So when the time is of no importance, that is future date we have to take the delivery of foreign currency, then we will enter into forward market. But the exchange rate, that is what will be the price of the other currency which I will have to pay, depends, is fixed now. So we will discuss each of these now. In the forex market, spot market refers to the immediate buying and selling of currencies for delivery within 2 business days. Generally, the next business day, generally the delivery of foreign currency, the delivery of the currency which we want to purchase takes place on the next date. Now, as a broadly 2 days they have been fixed, that the delivery of the other currency will take place within 2 days. This is known as T plus 2 settlement. What is the meaning of T? T means if you execute a foreign trade on Monday, that is, you have entered into an agreement or you want to purchase and you have placed the order today for buying another currency. Suppose this is today is Monday and I have placed order for buying the currency. So that day, which is today, will be represented by T, and the settlement means the delivery date will be generally take place on T plus 2, Monday, Tuesday and Wednesday. Wednesday is second day. So the settlement is broadly guided by T plus 2. Generally, the next day delivery of the other currency takes place. Spot market transactions are based on current market price of the currencies being exchanged. Suppose I am from India, where Indian rupee is the domestic currency, and I want to purchase US dollars. So $1 at current rate is approximately 83 Indian rupee, approximately. So in the case of spot market transactions, if I am from India and I want to purchase US dollars, I will have to pay 83 Indian rupee. So what is the present price of the other currency in the form of domestic currency? I will have to pay the same. The vast majority of forex transactions occur in spot market. If I want a foreign currency or the exchange of currency at some future date, it is forward market. But most of the transactions in the forex market takes place in spot section or spot market. Many individuals and businesses need to exchange currencies for immediate use. That is, they require the other currency for immediate use, such as for international trade. We are to import from other country, so we may be requiring the currency of the other country immediately, or we want to make investment in another country, we may be requiring foreign currency for the same, or if we want to visit other country, we may be requiring the currency of that country for traveling purpose. Many traders actively participate in spot market. Who are those traders? They are speculators. If I think that today is the today $1 is equal to 83 Indian rupee. If I am a speculative trader and I think that this is the first half of the session, this is the opening has just market forex market has just opened, and in the second half of the day, the market price of $1 is expected to reach 85 rupees. That is, you there will be the appreciation of US dollars in comparison to Indian rupee. Then as an Indian or as an other any other national, we may, as a speculative trader, we may be buying the foreign currency. That is, we may be tempted to buy US dollars. This is speculative trading. Many traders actively participate in spot market, speculating on short-term changes in the currency prices. That is, the rate may increase of the another currency, so we will buy that currency immediately. For this is the sort of transaction which takes place due to speculative trading. Now comes the forward market. It is a market where participants agree to buy or sell a specific currency for future delivery at a specified date and at a predetermined exchange rate. It means that suppose we want a currency, say we want euro. We are from India. Our currency is INR. We want euros. We want euros, say after 10 days, after 1 month, after 2 months, 3 months, 6 months. That is some future date. So we will determine that at this particular price, I will be purchasing euro by this date at this price. The price is determined at present. In the forward market, there is a delay between the agreement and the actual delivery of the currency. agreement is takes place today, and the delivery will takes place after certain time in future, which we have agreed to. If you book a foreign currency today and say that you will take delivery after 5 days, 10 days or 30 days, rate is decided today. That is, say, we can say that in future, after say 6 months, I will purchase US dollars at 86 per dollar. Rate may increase or decrease in the forward market. We have agreed that we will purchase the other currency at this price. Suppose now we have agreed in the forward market, that we will purchase 1 US dollar for 86 Indian rupee. Say after 1 month, I will purchase $1 at 86 rupees. It may be quite possible that the value of 1 US dollar may decrease. That is, it may be the cost of or the price of 1 US dollar may decrease to 81 Indian rupee, or the price of 1 US dollar may increase to say 90 Indian rupee. The price of the foreign currency may increase or decrease, but it will have no effect on foreign market transaction, because we have already agreed about the rate at which the transaction would take place in future, at which rate the currency will be bought. Most transactions in the forward market have delivery time frame of this 1 to 3 months. Most of the transactions in the forward market take place between 1 to 3 months, though in certain cases it may be even up to 1 year. It is said that up to 90% of the transaction in the foreign exchange market takes place in the spot market, and very less transactions takes place in the forward market. The forward market allows businesses and individuals to hedge against potential currency fluctuations and lock in an exchange rate today for a transaction happening sometimes later. What is the meaning of hedging? Hedging means taking some protective steps today to protect against fluctuation in prices in future. For example, if we think that we are going to import goods worth 1000 US dollars from America, we will be importing in the next say 2 months, going to import goods worth 1000 US dollars, and at present the rate is say 83 Indian rupee. So if we think that the price of US dollars is likely to increase to say the price of 1 US dollar is likely to increase to 90 rupee in 2 months, then we may think that we should enter into forward market transaction and we should purchase US dollars now. So this is hedging, so that if there is increase in US dollar, price of the US dollar, we may not have to pay extra. So we may agree that in this forward market that we will purchase US dollars at say rupees 85. We agree today that we will take delivery after 2 months. This is the here the rate is decided today. It may or may not be the market price. What is the present market price? We mutually, seller or buyer mutually agree that at this rate the transaction will take place in future. Example, a company in India planning to import goods from a USA may use the forward contract to buy the foreign currency at a predetermined exchange rate on a future date. This way, if the dollar strengthens against the rupee in future, say in the next 3 months, they are protected from paying a higher price for the dollar needed. So forward contracts are generally used less frequently because most of the transactions takes place in the spot market, and spot market transactions mostly reflect the day-to-day operations of the forex market. Most of the transactions in day-to-day pertain to the spot market. Both the spot market and forward markets can be used for speculation. Examples are there. In case of spot market, a trader might buy US dollar if they believe that it will strengthen against euro later in the day, aiming to sell it at a profit before the market closes. It means that forex market has just opened and we think that the price of other currency will rise in the later half of the day. It is expected we may buy the currency and we will sell it. We are speculating. We think so that market of other currency may fall in the second half of the day, but we think that it will increase, so we will buy the currency and sell it in the second half of the day. In the case of forward market, the speculator may think that the price of the other currency may increase after 1 month or 2 months. Then it will then enter into an agreement in the forward market. If they believe a specific currency will appreciate, they might enter into a forward contract to buy it at a lower price today compared to the expected future price. That is, suppose today the price of a one US dollar is 83 rupee, and they think that after 6 months the price of one US dollar is likely to reach say 90 rupee. So the speculator may enter into forward market transaction to purchase one US dollar for say rupees 85. So this is the forward market transaction, speculative trading in forward market. The spot market is commonly used for immediate currency use, immediate currency needs, business needs or traveler needs. The forward market is often employed for risk management tool and hedging against future currency fluctuations so that there may not be any fluctuation in the price of the other currency. The coexistence of both markets, the coexistence of spot market and forward market allows the participants to choose the most suitable approach based on their individual requirements, whether they want the other currency immediately or at a later date. So they may enter into the spot market transaction or forward market transactions accordingly on the basis of their specific needs. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.